Welcome to the Duck Dive. Today, we're digging into Circle Internet Group, ticker CRCL, and their Q3 2025 earnings. And if you were watching the market action, well, you know why this deep dive is needed. Circle put out what really looked like a fantastic quarter, phenomenal growth, announced right before the bell. But then the stock just cratered.
It's a classic investing puzzle, isn't it? And it really shines light on, the tension you get with these high-growth infrastructure companies. Circle's out there saying they're building the economic OS for the internet, right?
Yeah.
Critical stablecoin infrastructure. And look, the fundamentals for the quarter were genuinely excellent. The business today looks great. But the market just instantly skipped past that and focused on the guidance, the future risk, basically priced in fear, not results.
Okay, right. Let's unpack that. Starting with the actual numbers, because the beat itself was, undeniable. Headline EPS, GAAP and adjusted, both came in at 64 cents. You got to remember the consensus range was way down, like 17 cents to $0 34 cents. So huge outperformance there.
Yeah, absolutely blew estimates away. And the top line, too. Total revenue and that key reserve income line hit $740 million. That's up 66% year over year. Easily beat the street estimates, which were topping out around, $707 million?
And the foundation, the actual USDC in circulation, it just keeps growing. $73.7 billion by the end of Q3. That's a massive 108% jump compared to last year. So they're definitely grabbing stablecoin share.
But here's the kicker, right? But sets up our whole conversation today. Despite all those great numbers, CRCL stock finished the day down hard, 12.2%, trading near its lows since the IPO back in June. And get this, the trading volume was like 3.5 times the average.
Whoa.
Yeah. So when you see that kind of volume on a big down day after a beat, it tells you big money wasn't popping champagne over Q3. They were hitting the sell button, aggressively resetting expectations for what's next. We need to figure out why that massive beat got instantly ignored.
Agreed. Okay, so let's stick with the financials a bit longer, but maybe look under the hood at profitability, the operating structure. What's that telling us?
Well, if you look at the core business, the scaling is pretty incredible. Net income jumped 202% year over year, $214 million. Pushed their net margin near 29%. That's strong. Adjusted EBITDA up 78% to $166 million. And the really interesting part is the adjusted EBITDA margin. Expanded over 700 basis points, up to 57%.
Wow, 57% margin.
Right. That huge jump shows their core stablecoin business, once the pipes are built, is highly scalable, real operating leverage kicking in.
Okay, but leverage usually comes with costs somewhere, right?
Exactly. You have to look at this other metric they use, revenue less distribution costs, or RLDC. Think of it like their gross profit after paying out partners, the exchanges and platforms that help distribute USDC. So RLDC hit $292 million, which is good, up 55% year over year. Solid growth. But, and this is key, the RLDC margin actually squeezed down, compressed 270 basis points year over year, landing at 39%.
Wait, hang on, that seems counterintuitive. USDC circulation is booming, more than doubled. Shouldn't scale make distribution more efficient, driving the margin up? Why is it compressing?
Yeah, it tells you they're paying up for that growth. Those partner payouts, they scale pretty much directly with the amount of USDC out there. So essentially, they're sharing more of the economics to keep that USDC flowing and grab that market share. It's like the cost of acquiring dominance right now, and they seem willing to pay it.
Okay, that makes sense, and maybe that cost is worth it if you look at how much is landing on their own platform. USDC held directly with Circle just exploded. $10.2 billion. That's over 1,200% growth year over year. That suggests real adoption, like institutions, developers building directly on Circle, not just trading it elsewhere. And their overall market share climbed to about 29% of the big USD-backed stablecoins. Now, let's be really clear where the bulk of the money is actually coming from right now. It's that reserve income, right, thanks to high interest rates, generated $711 million this quarter alone.
That's the absolute crux of the financial picture right now. That $711 million is basically bankrolling this whole strategic transition. But it's incredibly sensitive to short-term interest rates. If, or maybe when, the Fed starts cutting, that revenue stream shrinks fast. And that's why management is so focused on boosting that smaller other revenue line, the fee-based stuff. Subscriptions, services, transaction fees. We only $29 million this quarter.
Only $29 million versus $711 million. Big difference.
Huge difference. But it's growing fast, up $28 million year over year. And critically, it's not directly tied to interest rates. That's the structural stability they need for the long haul.
So the whole game is pivoting from being like a high-yield money market fund manager to a diversified tech infrastructure company, the economic OS thing.
Exactly. That's the narrative. And this quarter, we got a lot more detail on how they're building that infrastructure out.
Right, like the ARC network. They launched the public testnet. Said over 100 institutions are already playing with it: banks, capital markets firms, payment companies.
Yeah, this isn't just about stablecoins anymore. It's looking like a serious attempt to build a regulated institutional settlement layer. And what was really fascinating, I thought, was the hint about a potential native ARC token.
Oh, yeah, they mentioned exploring that.
Yeah, stressed. It was just exploration, no decision, no timeline. But still, imagine using a token to align everyone's incentives on the network, drive utility. That could totally transform the economics, make it more like a traditional blockchain protocol. Plus, they mentioned USYC, their tokenized money market fund, roughly tripled assets to about $1 billion since June. Real assets, real utility.
And that utility piece connects to the Circle Payments Network, CPN. That seems to be getting real traction globally. Live in 8 countries now, 29 financial institutions signed up, another 55 in review.
And a pipeline of like 500 more institutions waiting.
Yeah, the momentum seems real. And they're seeing actual volume, too.
Yeah.
Trailing 30-day activity points to maybe $3.4 billion in annualized transaction volume already. And they highlighted partnerships with big names: Brex, Deutsche Börse, Visa. That's serious institutional integration for treasury and cross-border payments, stuff that builds a real competitive moat, regulatory and technical.
Which brings us right back to that tension point. All these strategic wins, looking good.
Yeah.
But then there's the guidance and the risk factors that clearly spooked investors enough to ignore all that.
Exactly. The forward guidance, it was a mixed bag, wasn't it? Good news first. They did raise the full year 2025 target for that crucial other revenue stream, now expecting $90 to $100 million. And they expect the RLDC margin to be at the high end of the old range, around 38%. So positive signals there. But, and this is the big one the market grabbed onto, adjusted operating expenses. They jacked up the forecast significantly.
Yeah, raised it to $495, $510 million for the year. That's a pretty chunky $20 million increase from what they said before.
And that spending increase isn't just like office snacks, right?
No. It's the direct cost of building out ARC and CPN fast. It's more money into global sales, platform development, and apparently higher payroll taxes linked to stock compensation. So the market immediately started asking, okay, is this spending going up faster than that a sustainable fee-based revenue can catch up?
And that question ties straight into the biggest fear: rate sensitivity, or maybe call it yield compression risk. Today's juicy profits are overwhelmingly from earning interest on the USDC reserves, short-term rates. With the Fed likely to cut rates eventually, the market is pricing in a big squeeze on that main income source over the next year, year and a half.
That's the worry. Higher spending hits now, while the biggest revenue line faces a potential future decline. Can that other revenue, the fee stuff, scale up fast enough to fill the gap? That's the bet you're making. Now, management pushed back, pointing to positives like the Genius Act, that's the potential U.S. stablecoin law, and getting licenses globally like MiCA in Europe, saying these things build a regulatory moat, make it hard for competitors, which is probably true long term. But on earnings day, the market just zeroed in on the immediate cost and the rate risk, hence the sell-off, the high volume reset.
So the street story is kind of like, oh, awesome quarter, congrats. But the cost of building the next business, the diversified one, is hitting the books just as the easy money from interest rates might fade. And that sell-off pushed the RSI, the relative strength index, down to 28, deeply oversold. Suggests a major reset in how people value this thing.
Okay, time for our This Is Not Financial Advice segment. Quick reminder, we're just exploring ideas based only on the call data. Talk to a pro before doing anything. All right, let's hear an outrageous but plausible trade based on this earnings mess. Okay, so the core idea is simple. The market reaction is a massive overreaction. It's fixated on the OPEX bump and the rate risk, totally discounting the strategic stuff coming online, especially ARC mainnet, CPN adoption. Stocks technically beaten down, oversold, near those post-IPO lows. The market just isn't pricing in that medium-term story, the infrastructure compounder potential.
Right. So how do you play that perceived misprice?
A pitch is a pairs trade. Go long CRCL, but short a general fintech ETF, say Global X Fintech ticker FIX. Why? Well, look at the performance gap. Over the last 3 months, CRCL is down what? Almost 44%? Though FinTech is only down about 3.4%.
Huge divergence.
Massive. The rationale is CRCL has just been punished way harder than the sector. So the bet is the strong Q3 results, plus maybe some positive news flow around the Genius Act or ARC network effects, that could spark a mean reversion. Maybe a 30% rally just back towards where it was trading before. While the broader fintech space might stay kind of sluggish due to macro headwinds, you're basically betting on Circle's specific infrastructure story winning out over generic sector exposure.
Okay, that's a clear, sharp take on it. So, wrapping this up, the main takeaway feels like Circle absolutely crushed Q3 on the fundamentals. USDC growth is flying. The strategic build-out with ARC and CPN looks promising. And yet, investor fear about higher spending now and lower interest income later just hammered the stock on huge volume.
Which leaves you, the listener, with a big question, doesn't it? Can Circle make that pivot? Can they shift from being a float-driven trade, living off reserve interest, to becoming a true infrastructure compounder, earning fees from ARC and CPN before falling rates really bite into earnings? What's the actual long-term prize for being the economic OS for the internet, especially if the road there is this volatile?
That's definitely the strategic timeline we'll all be watching very closely. Thanks for digging deep with us today. We'll catch you on the next deep dive.